We would like to take this opportunity to wish everyone a very happy new year, and may you enjoy it in good health. Well, we just wrapped up what could easily be considered an excellent year. Other than the US dollar and the energy sector, it's hard to find anything that didn't have a positive return. We started the year moderating return expectations for the US market in the high single digits, a bit higher but not much for international and emerging markets. We were concerned with the direction of interest rates and what it would do to the price and return for fixed income securities. The US market ended the year with surprisingly good returns across the board. The market represented by the S&P 500 was up just over 20%. The MSCI All Country World ex-US was up close to 30%, and emerging markets were up close to 40%. In the fixed income markets, long-term treasuries were up over 8%, Treasury inflation notes were up about 3%, and high-yield bonds were up over 7%. Currently, the concern is what happens next. As much as this question gets pondered in the media, we simply don't know. However, there are several observations that may bring some clarity. Economic growth and corporate profits continue to improve and accelerating globally. U.S. growth is steady and improving. European growth has surprised on the upside, and there are signs it has room to grow. Japan is awakening its domestic market, and that could propel its markets even further. Emerging markets, although not cheap, are relatively well priced when compared to the more developed markets. Interest rates are showing signs of a steady path to moving closer to their natural levels. Inflation remains subdued, and that has kept the pace of interest rates increases at bay. The recently passed tax reform will surely have some positive benefits for U.S. corporations, given that their tax rates have been reduced. Fiscal spending should go up, and that will hopefully trickle down to improve employment numbers. Speaking of trickling, with the benefits of corporations spending more due to lower taxes, comes a possible positive trickle effect to foreign companies given the amount of imports the U.S. demands. We continue to favor equity investments over fixed income, but as rates continue to rise, the relative attractiveness of bonds will increase. We're looking at seeking opportunities outside the U.S. in both developed and emerging markets. And lastly, given the expected increases to volatility and the well-priced status of most equity markets, we favor an increased exposure to non-correlated assets such as commodities, alternative credit, hedge funds, and private equity. These types of investments are long-term and carry liquidity and other risks and aren't for everyone, but for those that have the appetite for enhanced diversification, we think it makes sense to look more closely at them as part of a diversified portfolio. We would like to end by expressing our gratitude to those that have supported us throughout this year, and we look forward to the privilege of serving you in the coming year. Thank you very much.